It's rare to see a tech giant go from being doubted to becoming the strongest performer in one of the most competitive markets on Earth. But that's exactly what has happened with Alphabet, the parent company of Google. Over the past year, the company has not only defended its dominance, it has surged far ahead of its peers in the artificial intelligence race. And the outcome has been powerful. The stock has jumped roughly 70% over the past 12 months, hitting record highs and outperforming the rest of the Magnificent Seven. Today, we're diving into what changed, why Alphabet has pulled ahead, and what the next 1 to 2 years could look like for the stock. Just 1 year ago, the sentiment around Google was tense. Regulators had labeled the search giant a monopolist, sparking fears that the company could be forced into a breakup. At the same time, the rapid rise of generative AI, and especially the explosive growth of ChatGPT, had investors worried that Google Search, its most valuable business, was suddenly vulnerable. AI was the first real threat to search advertising in years, and the market reacted accordingly. Alphabet shares traded at just 20 times forward earnings, cheaper than the S&P 500, and by far the lowest valuation in the Magnificent Seven. Fast forward to today, and the situation looks completely different. The feared breakup never happened. Regulators ultimately delivered relatively mild penalties, removing the threat hanging over Alphabet's future. And rather than let AI eat into its business, the company reinvented itself and proved it could compete at the highest level of AI innovation. One of the largest catalysts has been the launch of Gemini 3, the latest version of Google's flagship AI model. The newest iteration pushes forward with stronger reasoning capabilities, new developer tools like generative user interfaces, and features such as DeepThink and improved code generation workflows. These upgrades signal that Alphabet is not only catching up, it's matching the leaders in certain areas and building a large, engaged user base behind its AI products. According to the article, Gemini has already reached around 650 million monthly active users, a significant foothold in the global AI ecosystem. Meanwhile, the financial engine behind all this innovation has never looked stronger. Alphabet stock gains weren't fueled only by hype, they were powered by real business performance. Over the past year, earnings expanded sharply and profit margins pulled higher even as the company ramped up AI spending. In the most recent quarter, Alphabet grew its pre-tax profit by 39% while expanding margin by 7 full percentage points, despite boosting capital expenditures from $13 billion to $24 billion. That is execution at the highest level. A chart on page 3 of the uploaded document visually shows this progress, where Alphabet's pre-tax income margins steadily climb quarter after quarter, even outpacing Meta in several periods, a key comparison given both companies are pouring massive capital into AI. And that's where the investment case becomes compelling. Even after the recent surge, Alphabet is still the second cheapest of the Magnificent Seven, trading around 26 times earnings, with only Meta priced lower. But unlike Meta, which has seen profitability fall as it pours more into its AI infrastructure, Alphabet is finding ways to scale innovation while still growing profit. That distinction matters. This is why long-term investors like Berkshire Hathaway have recently taken positions in Alphabet, a rare move considering Warren Buffett's long-standing skepticism towards most tech stocks. That alone should make anyone pause and take a second look. So where does Alphabet go from here? For the stock to continue performing, earnings need to keep climbing. Analysts expect 2025 earnings to land above $10 per share. But for the momentum to continue beyond that, 2026 earnings likely need to reach $12 to $13 per share, higher than Wall Street's current estimate of around $11. And looking at Alphabet's recent execution, that's entirely within reach. One of the biggest growth engines is Google Cloud. The cloud division has already become a profitable segment, and analysts expect revenue to rise from $57 billion in 2025 to roughly $75 billion in 2026. This is where AI demand becomes crucial. As companies build, test, and deploy AI applications, Google Cloud's infrastructure, developer tools, and integrated AI services position it to capture a growing share of enterprise spending. Analyst Dan Salmon believes this cloud momentum, fueled by AI, could be the major catalyst for shares in the coming years. And AI demand isn't slowing down. NVIDIA's massive earnings report on November 19th confirmed that global investment in AI is still accelerating. In fact, the four major hyperscalers, Alphabet, Microsoft, Amazon, and Meta, are expected to ramp their AI infrastructure spending to nearly $366 billion in 2025, $478 billion in 2026, and $534 billion in 2027. These aren't just big numbers, they represent the largest technology spending cycle in history. A visualization on page 6 of the uploaded file also shows Alphabet outperforming all other Magnificent Seven stocks over the past 12 months, an impressive trend in a group that includes Nvidia, Tesla, Microsoft, and Amazon. Alphabet didn't just keep pace, it pulled away. The company's also playing the long game when it comes to AI leadership. Each new generation of Gemini brings more advanced features, better reasoning, and more intuitive user experiences for both consumers and developers. That creates a flywheel. Better models lead to more usage leads to better data, and better data fuels even stronger models. Analysts expect Alphabet to use AI to create entirely new revenue opportunities across search, YouTube, cloud services, Android, and enterprise tools. This means the stock no longer needs to be cheap to be attractive, it just needs steady execution and continuous innovation, and so far it has delivered both. So what should investors do? If you already own the stock, there's a strong case for holding on. Even after a sizable run, the company is still reasonably valued relative to its peers. It carries a dominant market position, is innovating aggressively in AI, and continues generating some of the strongest cash flows in the sector. The long-term outlook is supported by expanding cloud demand, improving margins, and consistent leadership in search and advertising. If you're considering adding shares, timing the perfect entry is always difficult after a big rally. But the long-term story remains intact. Alphabet is transforming from a legacy search giant into a diversified AI powerhouse. It might not repeat last year's outsized gains, but the fundamentals point to continued steady growth ahead. In a world where AI leadership will define the winners of the next decade, Alphabet has positioned itself not just to participate, but to lead. And if the company keeps executing at its current level, this AI winner may still have plenty of upside to deliver.